There's a loan program specifically designed for business owners, one that allows without tax returns, without W-2s, and without pay stubs. Instead, it focuses on one document that actually reflects your real income, your profit and loss statement. Let's talk about how this is a game changer. Tax returns say one thing, but your P&L tells a much different story. Today, we're going to dive into the profit and loss loan and finally let entrepreneurs qualify based on how their business actually performs, not how it looks on paper. I'm Ryan Marks, host of SEI Podcast, and I'm here to empower self-employed professionals and property investors with real mortgage solutions that reflect your true financial story. I'm excited to talk about this P&L loan product, which is just another amazing non-QM loan tool that entrepreneurs and property investors as well can utilize that does away with your tax returns. In addition to that, like the bank statement loan that we talked about in a previous episode, this is the only source of documentation that the investor is going to use to qualify your income piece. So what exactly does that mean? Well, again, normally when you purchase a property, you have to use 12 or 24 months tax returns, and whatever your gross adjusted net that has been filed with the IRS is what the lender or investor is going to use to derive your qualifying income. So the P&L loan, when your bookkeeper or tax preparer prepares your profit and loss statement, whether that's quarterly, annually, however it's set up, typically the investor that you're working with is only going to require your most recent 1-year profit and loss statement. So as your business is performing and maybe potentially hasn't utilized all of its tax deductions yet, you're qualifying based on what that current profit and loss statement is reflecting. Let's break that down a little further, right? What are some of the key points that the investor is going to look for when utilizing this profit and loss loan statement to qualify? Well, number one, typically to get any sort of reasonable interest rate, I guess you could say, you would want to have this profit and loss prepared by your tax preparer or your CPA. It's not a self-prepared P&L, although we do work with investors where if you have a self-prepared profit and loss, meaning it's a profit and loss that you put together for your business, there are loan programs that will utilize that, but typically, you're going to have a much greater down payment, at least 20% down payment, and there may be some other restrictions, that come with that because again, it's weighed on risk, right? At the very least, your tax preparer, your CPA has said, yes, this is what your business is reflecting as potential, profit and loss. So what it's doing away with though is no tax returns, W-2s, pay stubs, any of that additional income, the bank statements. It's solely designed for business owners where you don't fit in those traditional QM boxes and you're using what your gross adjusted net for either year to date or the previous year's earnings based on your P&L only. So in addition to the profit and loss statement, you need to show the investor or lender that you've been self-employed at least for 1 year. And that's if you've been in the previous profession prior to moving out on your own, that you have experience in that line of work. So you could have been a contractor working for a builder building homes, and now you want to go out on your own and be your own contractor or general contractor and help folks renovate to fix and flip or just do general remodels on someone's primary residence. So you've had the experience in your profession as a W-2 wage earner, and now you've moved into self-employed, and that could be self-employed as a sole proprietorship, or you could be incorporated. You're not required to be a business owner and have an LLC or an S or a C Corp. You can just be a standard sole proprietor where you're just reporting your income solely on your individual 1040s and you have no other business returns or schedules for that matter, and utilize the P&L profit and loss loan. So in addition to proving that you're self-employed, you have to meet the minimum down payment requirements. So again, this is another loan similar to the bank statement loan, which is also in the non-QM space, where the lowest down payment available on a P&L only loan is 10% down, and that is if you're purchasing a primary residence, and 20% down if you're purchasing the property with the intended use of being an investment home. So that could be a short-term rental or a long-term rental, but that would require 20% down. Now, on the 10% down option, again, that will come with slightly higher interest rates because you have less skin in the game. You're using a P&L loan product. However, like the bank statement loan, it will still have no monthly mortgage insurance as part of your payment if you're utilizing that 10% down loan option. So typically, if you put less than 20% down, you're going to have mortgage insurance in addition to your regular principal and interest payment on top of your taxes, insurance, and homeowners association dues. So aside from that, your profit and loss statement, proving you're self-employed, your down payment, you may potentially have to provide some sort of proof of reserves, meaning depending on what your loan amount is and your purchase price, the investor may require that you have 3, 6, 9, or even upwards of 12 months if your loan is typically above $1 million financed. And that's just showing the investor that you have additional funds available to ensure that if business changes, you can still make that monthly payment on a regular basis. Because just like all the other non-QM programs that we go over, you have to still meet the ability to repay rule. So the investor wants to know what sort of safety net you have available. The good news, though, is you can actually use funds from your business account if you want to show those as your reserves, aside from if you have a IRA or a 401k or other stock, savings bonds accounts. Those are all acceptable assets that you can utilize for reserves if the particular P&L loan program that you're going with does have a reserve requirement. There are plenty of P&L loan programs, though, that do not require any sort of reserves. But again, the more information you can provide the investor, the better it's going to be as it relates to your financing terms. So that means what sort of interest rate you're going to receive. The greater down payment that you apply, you'll receive a more competitive interest rate. The same thing goes with your credit score. The higher your credit score is, can give you a better interest rate. So it's important that you still take care of all of those things, even though you're utilizing these great non-QM products, because although they are less restrictive as far as the documentation is concerned, they still follow the same line of what derives an interest rate, right? Which is the occupancy type. So if you're purchasing a primary versus an investment home, what your credit score is. So if you have, a 620 and someone else has a 740, they're likely going to be receiving a better interest rate just solely based on their credit score. And your down payment is another thing that helps drive that final interest rate that you're receiving from the investor. And then lastly, the terms of the loan. So what sort of terms are available on these P&L products? Well, believe it or not, pretty much every term is available. You can do a 3, 5, 7, or 10-year ARM. You can even do an ARM with an interest-only payment, and you can even do an interest-only payment up to a 40-year term. So what that means is if you're looking to utilize the lowest possible minimum monthly payment, where, again, if you're just making the interest-only payment, you're just paying the investor the interest to lend that money. It's none of your principal balance will be paid down, but if there's a reason why that makes sense for you to take advantage of that lowest possible payment, you still have to qualify a different way than what you actually see when you're making your monthly payment. So let me give you an example. If you're utilizing a 40-year loan with the first 10 years interest only, the investor is going to qualify you based on what the 30-year remaining balance is of that mortgage, because they have to assume that if you took advantage of interest-only payments for the entire 10-year term and it has to be paid off in 40 years, well, then your payment's going to increase. So essentially, it's just going to re-amortize over the remaining 30 years and become a 30-year loan for all intensive purposes. So why it's nice that you can go with a 40-year term is because if you're utilizing a 30-year interest-only, and you would do that because the rate is better than going with a 40-year interest-only, that means that you have to qualify on your P&L income on essentially a 20-year payment, because if you make the payment for 10 full years and you stay in that loan for the entire remainder of the term, you have to have it paid off in 20 years. So it's going to amortize what your original balance was if you made no payments on it, and then that remaining original balance will then be amortized over the remaining 20 years. So similar to adjustable rate mortgages, if you use, let's say, a 3-year or a 5-year ARM, what that means is that rate is fixed for that period of time. Nothing can happen. It cannot change whatsoever. But when that initial teaser rate, as they call it, is up for adjustment, depending on where interest rates are at that time, when your 3, 5, 7, or 10-year ARM adjusts, you may see an increase in your monthly payment if interest rates have come up. The good news, though, is there are safety nets in place, meaning it can't just immediately move up to whatever the current interest rates are. So let's say, hypothetically, you took a 3-year ARM loan using the P&L product and your rate was a 6%, and then after 3 years, rates are now 8%, which we hope that never happens, but we did get up there at one point not too long ago in the conventional space. So, I never say never. But that doesn't mean your 6% rate would automatically go to 8%, or let's say rates were 10%. It wouldn't just shoot up to 10%. It has a margin in place, but it's important that you speak to your loan officer to find out what that margin is associated and also how often it can adjust on its adjustable rate period, every 6 months or every 12 months. So typically it's every 12 months, but there are loan products where it can adjust every 6 months until you refinance that loan or pay it off or sell the property. So that's pretty wild that there's that many programs available just within this profit and loss loan qualifying documentation product. Now, what are some of the property types that you can utilize this for? Well, it's essentially an open book as well. You can use a P&L loan to purchase your primary residence, a second home, an investment property, and up to a 2 to 4 unit property. So that means you could potentially qualify with a P&L loan and purchase a fourplex with this particular product. Now, in addition to that, if you already own a property, you can take cash out on this property, whether it's an investment property, a second home, or your primary residence, using this profit and loss loan. Now, it's important that if it is an investment property, you're looking at what the best loan product is available for that. Maybe that would be better fit for a DSCR, but it is available if you're wanting to utilize the P&L loan product for a cash out transaction. So who is this P&L loan good for? Well, one of the major advantages of using this profit and loss loan is because it does not require tax returns, you don't have to have your tax returns filed up to the current date. So let me break that down. Normally when you're working with the bank and you're trying to qualify for a mortgage and you're self-employed, you need to have your most recent tax returns filed, or at least, at the very least, if they're due. So for example, if we're now past October and you have to have the previous returns filed, typically it's very difficult to qualify for a loan, even if you're on an extension. If you are on an extension that your tax preparer has filed on your behalf, you have to provide a profit and loss statement, but they're going to use your previous year's tax return. So let's say your business did really well the most recent year. Maybe that's why you took a little longer to file taxes, because you're trying to utilize all the write-offs available to you to help further shelter your income. But the bank doesn't care. They need to see what the most recent filed usable tax returns are. Where a P&L loan is, you could use your last year's income earned that's based on the profit and loss, even if you don't have that most recent year filed yet. I mean, that's a game changer. Like when it comes to qualifying for a loan and just stepping outside of that traditional QM sandbox, it allows a business owner whose business moves and changes constantly to give them a vehicle for financing so they can purchase a property. Another good example of where the P&L loan would be a good fit is if you're in the type of business where you have peaks and valleys with sales throughout the year, you may not be in a good time or maybe in a lull where you're not reflecting as much income, but you can utilize the profit and loss statement from the previous year's wages in order to show the strength of the overall business, right? Or if you're in a situation where maybe your income has increased drastically, again, the bank won't take your year-to-date income earned because it has not been filed on tax returns, where if you had your CPA or tax preparer provide your year-to-date P&L, we could take an average of that year-to-date if we're barely in the beginning of the year and combined it with your previous year's income, or if we're far enough along in the year, typically 6 months. So as long as we're in June or thereafter, you could just use simply your year-to-date P&L and isolate all the income that you've earned because now your business is doing much better than it's done the previous year. Or if you recently started a business, again, you may have been a wage earner transitioning into self-employed, and you may have had a lot of write-offs reflected on startup costs, within the beginning stages of your profession, but now your income is starting to increase and you're starting to have an upward trend with your gross sales, and you can utilize that P&L as a source of income versus your previous most recent filed returns as you were just starting up. So here's an example of a real life situation where a P&L loan would translate into income much differently than, say, their tax returns. Maybe you earned $400,000 in gross sales for the previous year, like previous 12-month calendar year, but you wrote off $300,000 of that income, leaving you with $100,000 in taxable income. But your profit and loss shows that these are isolated one-time expenses, or they're not reflective within your current year-to-date income because you're using now your P&L from the current year versus the previous year's income, or combining those. And let's say that P&L has a gross adjusted net prior to filing of $300,000 versus $100,000. That's $200,000 difference in qualifying income that you can divide by 12 in order to give you your monthly qualifying income, which is extremely powerful when you're utilizing a P&L loan product versus an actual filed tax return. And as far as the qualifications, once we've derived that income, there still is a DTI ratio, or debt to income ratio, that the investor is going to use, which is typically up to 50%. But again, that's a 50% to the percentage available to you, meaning if your expenses divided by your income hits 50% right on the dot, you are still well within guidelines to utilize that P&L product. But again, more often than not, your debt to income ratios are much lower because you're utilizing the P&L loan program versus what your gross adjusted net may reflect on your tax returns. So debt to income is still a requirement. Again, a credit score is still a requirement. There are lower credit score programs available within this P&L product, but typically the majority of the investors will require you to have a 620 credit score or higher, and some of them range in the bucket of a 660 or higher, because they just want to see that your previous payment history or your overall credit worthiness is relatively strong, because this type of loan program is so limited as it pertains to qualifying income documentation that the investor wants to feel comfortable around other areas, that they have access to, which would be your credit report will show what your payment history was, how many trade lines you've had, have you had a mortgage previously or not. But again, not required. You can be a first-time home buyer and utilize this program. You're just limited to a minimum of a 10% down payment when going with the P&L loan program versus some of the other standard qualified down payment programs that are out there within the QM space. So we've gone over a lot of benefits with the P&L loan, but to simplify it, the biggest benefit would be no tax returns needed whatsoever, no additional income documentation. Your income is solely qualified on your profit and loss statement and can be self-prepared in some situations or prepared by your tax preparer or CPA. It's very quick approvals. If you have a tight escrow, you can close very quickly on your property. Because of the limited documentation required, you're not jumping through all these additional hoops in order to get your loan through to the finish line. It's ultimately has a much higher qualifying rate. You can use it for primary, secondary investment and cash out refinances, and you can be self-employed as little as 1 year as long as you've been in that previous profession and still utilize a profit and loss loan program. So if your tax returns are showing inconsistent income, a profit and loss loan will capture what your true financial worth is as it pertains to your business, and could be a vehicle for you to obtain homeownership or further build your real estate portfolio. And for more information about the P&L loan product, head over to sceimortgage.com, where we have tons of additional tools and resources. And if you're looking to get in touch with us, all of our contact information is there. We welcome the opportunity to hear all about you and your business and how we can utilize some of these great programs as a vehicle if you're looking to purchase a property or build your real estate portfolio. I'm Ryan Marks, telling you to let your money work smarter, not harder.